Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're taking a look at three rather under-the-radar stocks that have crushed the market over the last 5 years to consider buying and holding heading into their upcoming earnings releases. Those three stocks are Badger Meter, which trades on the ticker BMI, nVent, or nVent, how they pronounce it. So it's NVENT Electric, and then that trades on the ticker NVT, and then Stride, which trades on the ticker LRN. But before we get everything, remember to subscribe and leave a review wherever you listen to your podcast, and make sure to check out our Zacks.com/promo page for a look in some of our services, portfolios, and more. So before we jump into these three under the radar stocks, I'm going to go quickly into where the market stands at the moment, just in the sense that we had the inflation numbers come out September's inflation numbers as we record this on Thursday afternoon, and then we're looking ahead to the start of the busy portion of Q3 earnings season, which kicks off on Friday morning with JP Morgan and the big banks. So Wall Street cares about really two things above all else, and that is earnings and interest rates. Investors have been forced to pull back on their bets that the Fed's going to start slashing its core rate after starting its easing cycle with a 50 basis point cut. September's inflation data came in slightly hotter than projected, so the 10-year Treasury yield is back up to about 4.1, about 4.08% as I record this now. This is versus those mid-September levels of about 3.64%, which were 52-week lows. Thankfully, we're still way below the highs of the last several years, which was about 5% last October. That said, also the slower easing cycle for the Fed is preferable in the long run, considering that a rapid rate cut would likely mean that the U.S. economy is tanking, and the Fed's then having to just rip the Band-Aid off as quickly as possible to help do as much as they can to support the economy. So slower easing cycle is actually preferable because it means that the U.S. economy is on somewhat solid footing. So with that backdrop, with interest rates, we're going to turn the page to earnings. And as I said, earnings season kicks off tomorrow with JP Morgan, and then kind of the next several weeks is just they're coming as quickly as possible with all the biggest companies reporting over the next several weeks. So total S&P 500 earnings for the third quarter are expected to be up about 3.1% year over year. And these estimates have come down significantly from the start of the third quarter. So on July 5th, Zacks estimates were calling for about 6.9% revenue or earnings growth for the S&P 500. And now, as I said, that's 3.1% today. So that's a more significant decline in estimates relative to the comparable periods for the preceding two quarters. So it's significant to see that pullback in these earnings outlooks. Actually, the only two sectors of the 16 Zacks sectors that have seen their estimates improve since the start of the third quarter are tech and finance, which could then put a lot of pressure on especially big tech to roll out impressive guidance, since tech has driven the market higher. So if we look at the whole, we're calling for, as I said, 3.1% earnings growth for the S&P 500 on about 4.4% growth in Q3. And then if we look ahead, we're calling for about 9.6% earnings growth in the fourth quarter. And then if we look ahead to 2025, we're calling for really impressive growth for 14.6% earnings growth in 2025 versus an expected 7.8% in 2024, and then another 13% in 2026. So this is when we start to get into the idea that if guidance comes in low for some of these big tech stocks, there's likely going to be a significant recalibration. The market's gone up really significantly off those 2023 lows, and then we've been on a really big run in 2024. So one of the first bellwethers out next week is Taiwan Semi, which reports on October 17th. So that's a report to certainly pay attention to, as it could be kind of looking in to see the future of the near-term outlook for the likes of NVIDIA and Apple and all these big tech companies, since they are the chip making powerhouse. So that's the backdrop we're sitting on now. So as long as earnings results or earnings guidance, especially for big tech, doesn't just tank, the market should hold up pretty well. And we should note that October can be volatile, especially heading into the unknowns of the election that's just around the corner. So with this in mind, though, we're going to take a look at the first of these three stocks we're looking at today, and that is Badger Meter, which trades in the ticker BMI. It's set to release its third quarter 2024 results before the market opens on Thursday, October 17th. So next Thursday, Badger Meter lands a Zacks ranking number 2 buy right now, and it pays a dividend, and the company's earnings and revenue growth outlook is really impressive. So let's dive into a little bit more about the company and then some other fundamentals to consider. So Badger Meter is an investment into the wider world of water as it benefits from the mounting long-term commitment to water conservation. Its flow measurement, water quality, and control products serve water utilities, municipalities, commercial and industrial customers around the world. The company's high-tech smart water metering solutions empower its customers to optimize the delivery and use of water to maximize revenue and reduce waste. Its offerings are hardly flashy. It runs a very kind of behind-the-scenes business that most people never think about, but water-focused tech is growing in popularity as the U.S. and countries around the world spend heavily to preserve water at every level, because water is really one of the essential global resources, and it must be optimized at every turn. It's posted pretty impressive revenue growth over the last 25 years, including a recent boom over the last 3 years that was capped off by 24% growth in 2023. In Q2, it beat our earnings and revenue estimates. It's now topped our EPS estimates over the last 4 quarters by an average of 13%. And if we look ahead to 2024, we're calling for another 17% revenue growth for the company after that big stretch of growth over the last several years, and then another 8.5%, nearly 9% growth in 2025 to get up to about nearly $900 million in revenue next year. And then on the bottom line, we're calling for another 31% adjusted earnings growth in 2024, and then 14% higher earnings growth next year for Badger Meter. In overall, its earnings estimates for 2024 are up 25% over the last 12 months, and its outlook for 2025 is up 29%. So its earnings revisions have trended significantly higher over the last year, and its most accurate estimates for 2024 and 2025 have come in slightly above their already improved consensus. That helps it land that Zacks rank number 2 buy at the moment. Overall, the stock's up about 330% in the last 5 years. This outpaces sector's 150% climb, and over the last 15 years, it's soared over 1,000% to crush the S&P 500, which is up around 475% during that stretch. If we look more recently, BMI is up about 45% in 2024, and it just recently hit new all-time highs, so it's a little bit overheated at the moment. It could pull back to its 21-day or 50-day moving averages in the near term, so maybe some investors want to wait until after the report if there's possibly a pullback. But if you're a longer-term investor, you don't need to time things too precisely, since you never know exactly how the stock's going to react, because you can never know exactly what the guidance is going to be. And then if we look back in August, the company raised its dividend by 26% to 34 cents per share. This company said at the time that a durable dividend is an important component of our capital allocation framework, and we are immensely proud that they've now raised their dividend for 32 consecutive years. So that's really another added bonus for Badger Meter. The payout ratio is pretty solid as well, so there's room to continue to boost that payout. It also has a really impressive balance sheet with no debt. And it's, as I said, it's could have a little bit of a pullback in the near term after it hit fresh highs, and it's been an impressive run. Its shares were down around 2% as we record this Thursday afternoon. But overall, Badger Meter is an under-the-radar stock that's offering something that most people never think about, but it's an essential part of the economy, and it's never going to go out of style. So Badger Meter is certainly a stock to put on your radar heading into earnings. And now we're going to move on to nVent Electric, which trades in the ticker NVT. And the company spells its name NVENT. So it's pronounced nVent. It's projected to release its Q3 results on October 25th, though the company has yet to confirm that official release date. So nVent Electric is a top provider of electrical connection and protection solutions, benefiting from the electrification and energy transition trends, as well as sustainable building and beyond. Outside of energy-based megatrends, it's growing alongside the proliferation of data centers, which are then kind of a big reason for a lot of these energy transition stocks to be soaring, because all these big tech companies are going to be having so much more energy usage as they roll out their AI data center. So that's why nVent is a company certainly worth looking at. Some of its other products include enclosures, electrical connections, thermal management solutions, and much more. It also has cooling and climate control and electrical safety and electrical heat tracking and leak detection offerings. So a bunch of various offerings. They serve clients across energy storage, utilities, renewable energy, data centers, networking, and various other key industries in the economy. It grew its sales by 12% in 2023 after 18% expansion in 2022 and 23% growth in 2021. So really nice string of top line expansion over the last 3 years. The company also over the summer announced that it agreed to sell its thermal management business, and it closed another key acquisition. It said, quote, at the time, "These transactions represent a significant step to make nVent a more focused, higher growth electrical connection and protection leader and well positioned with electrification, sustainability, and the digitalization megatrends." So that's where we are at the moment. So if we look ahead, the firm is projected to boost its top line by another 12% in 2024. So that's 3 straight years of double-digit revenue growth, and then another 10% next year. So that'd be 5 straight years of solid double-digit revenue growth, and it would see it reach roughly $4 billion in sales in 2025. In terms of its adjusted earnings, it's projected to about 7% growth in 2024 and then 12% growth in 2025. And this would follow nearly 30% earnings per share growth last year. So solid bottom line growth as well. Its earnings revisions had soared since 2021. And that included really impressive revisions in 2023, though they have stagnated a little bit recently. They're still up from where they were this time last year, and its outlook for 2026 is up significantly from where it was at the start of this year as well, though it lands a Zacks ranked number 3 hold because of that recent stagnation. nVent Electric has climbed by 260% in the past 5 years to crush the S&P 500. And it's now neck and neck, though, with the benchmark over the last 12 months, which is a good sign. So if you missed out on that big run, it's cooled off a little bit. It's up 32%. The stock is back above its 50-week moving average, and now it's trying to retake its 21-week moving average, which is a positive sign for investors who take a look at some of those moving averages to get in and out of stocks. It's also currently above its 21-day, and the 21-day trend line moved above the 50-day trend line. So that's a positive sign to see the shorter data moving average move above that longer term trend. And it's trading at roughly neutral RSI levels. And it's currently trading around 19% below its average Zacks price target after it's fallen off of its highs back in the second quarter of 2024. So you're getting it at a nice price here at the moment. As I said, it's back above some key moving averages as well. The company also pays a dividend, and 7 of the 10 brokerage recommendations that Zacks has are sitting at strong buys with 1 buy and 2 holds, so no sells in there. And then in terms of valuation, it's trading at a 20% discount to its highs at 20.2 times forward 12-month earnings, and it's trading at a slight discount to its industry as well, which is a positive sign. So overall, nVent Electric is worth considering at the moment as it's trading solidly below its average Zacks price target and its highs, and its outlook is really impressive in a business that's benefiting from tons of longer term trends in the U.S. and global economy. And now we're going to close out with the last of these 3 under the radar stocks, and that is Stride, which trades with the ticker LRN. It's set to release its first quarter fiscal 2025, so it's on a very different fiscal calendar than most companies. Fiscal quarter of 2025 results on Tuesday, October 22nd. So Stride stock has soared about 400% in the last 10 years. It's trading right near all-time highs, yet it's trading near its lowest forward earnings multiple in the last decade. So the stock has soared, but its impressive earnings outlook helps its valuation look very, very worthwhile at the moment. So let's dive into some basics of what the company does. It's a digital education services company that attracts students of all ages in the U.S. and around the world. Its growing portfolio serves K through 12 students, parents, adult learners, school districts, businesses, the military, and beyond. It's expanding as more people dive into digital education and reevaluate college amid skyrocketing costs. It's also gaining steam in its career learning segment, especially from its middle school and high school cohort. So people who are thinking about getting into jobs where college then might not necessarily be the path they're going down, where a lot of even big tech companies aren't requiring college degrees anymore. They just want to be able to show that you know how to do whatever it is you know how to do. So that's another longer term trend that could benefit Stride. It's capitalizing also on the digitalization overall of the U.S. economy, offering courses for, as I said, middle school and high schoolers, and then anyone else in various fields such as IT and healthcare. Their tech elevator class, which boasted helps students become skilled coders in 14 weeks. So these are the various offerings that Stride has been expanding in recently. That's part of a wider trend that's really impressive, and we'll take a look at some of that growth. So Stride grew its revenue from $400 million back in 2010 to about $1.8 billion in 2023. Its sales popped 9% in 2023, 10% in 2022, and this came after it skyrocketed roughly 50% in 2021 when the COVID pandemic kind of permanently reshaped the education landscape in the workplace. So this kind of had a lot of people thinking, wait, maybe I can get some of these digital education offerings, and that just then becomes a big part of their business going forward, is that a lot of those clients realize this is something that I maybe not have known about before, and it's going to be really important going forward. So Stride grew its revenue by another 11% in 2024, so fiscal 2024, posting a beat and raise fourth quarter in early August. It also grew its adjusted earnings by a whopping 58% last year. If we look ahead, its growth is going to slow down a little bit. We're calling for roughly 6.5% growth in 2025 and 2026 on the top line, to get up to $2.3 billion next year. And then on the bottom line, we're calling for about 8% adjusted earnings growth and then 12% adjusted earnings growth next year. So after this stellar run, it's still doing solid top and bottom line growth for Stride. And its earnings revisions have roughly stagnated over the last few months, which is not a bad sign. It's just that's why it lands as Zacks ranked number 3 hold at the moment. That said, it's crushed our estimates by an average of 40% over the trailing 4 quarters, with solid beats over the last 2 quarters of roughly 9%, both of those periods. So impressive bottom line beats. Overall, despite that stagnation, its earnings revisions, or its overall earnings estimates, are up significantly for 2025. So the current fiscal year from where they were this time last year, up about 13%, and they're up for next year as well. If we move back to the stock performance, the stock has climbed about 110% in the last year. This blows away the Zacks school industry, which is up around 30%, and the S&P 500, which is up around 32% during that stretch. In the last year alone, the stock is up around 60%, but it's only up around 24% year to date. So that could be a good buying opportunity for investors here. So the online education standout is not just, though, a post-COVID success story. If we look over the last decade, it's up 400% to blow away the S&P 500, which is up 220% during that stretch, and its industry's 44% climb. So as I mentioned, it's only up 24% year to date. It hit new highs in late September, and it's kind of tanked since then, or pulled back is more probably a better word to use. It's down 17% since the end of September after it hit some rather overbought RSI levels. So it's now hitting some of its most oversold RSI levels over the last several years. It's back below its 50-day moving average and possibly ready to tag that 200-day. So the 200-day has provided support, or it didn't even get down to the 200-day the last time it had a significant pullback. So if it does get down to the 200-day, that would kind of be a screaming buy, in my opinion, if you're looking at some of those moving averages as an indicator of when to possibly get in and out of stocks. Its improving earnings outlook overall, though, helps it trade at near all-time lows. It's trading at 14.4 times forward 12-month earnings, which is a 75% discount to its high and 35% discount to its 10-year median and 25% discount to its highly ranked industry. And it's growing its reach, as I said, through its expanded offerings in a rapidly evolving education world where more people are turning to digital education across different ages and demographics. So now might be a good time for investors to consider buying Stride stock and holding it. It's also supported by a really impressive balance sheet. And as I said, it's pulled back significantly after it hit new highs at the end of September. So maybe you want to wait until after the report if it falls possibly further. But as I said, it's already pulled back significantly over the last several weeks. So now could be a good time to consider Stride as we head into that earnings release. So that does it for this episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.